Hi, and welcome back to Talking Stocks. I'm Emily Whittaker. Today, we're looking again at Ciscom Corp. The company recently released its 2025 year-end results, and while the top-line numbers reflect a challenging year, the underlying data suggests a significant operational pivot that investors should have on their radar. First, let's look at the hurdles. 2025 was a perfect storm for Ciscom, but it's the why that matters here. And so does what the company did about it. A major labor dispute at Canada Post disrupted direct mail campaigns nationwide, and a bankruptcy from a significant client added further pressure. This led to a revenue decrease, coming in at $20.7 million compared to 2024's $35 million. However, here is where it gets interesting for investors. Despite lower sales, Ciscom actually became a more efficient machine. Their gross margins jumped from 19.5% up to 25.2%. EBITDA, before one-time charges, came in positive at $1.2 million. Net loss narrowed by nearly 38% year over year. And cash flow from operations? $4.3 million, up from $1.2 million in 2024. Management's cost-cutting measures saved over $400,000 annually, helping the company report a cash-basis net income of $451,000. That is a 207% improvement over the previous year. The real story for 2026, however, is diversification. Ciscom is moving aggressively advancing in adtech and martech with 3 new proprietary AI-driven offerings in Prospect Media Group: Engage Plus, Mixography, and Shopography. These are proprietary tools sitting at the intersection of analytics, digital marketing, and direct mail enablement. By integrating AI into their data-driven analytics, they are reducing their reliance on traditional mail and positioning themselves as a high-tech partner for omni-channel media for retail advertising. Financially, the company remains on solid ground. They generated $4.2 million in positive cash flow in 2025 and maintain a strong standing with their banking partners. As CEO Michel Pepin puts it, 2025 was about repositioning. With the mail disruptions resolved and new AI tools in play, Ciscom is entering 2026 leaner and more tech-focused than ever. The bottom line on Ciscom, 2025 was a stress test, and they passed it with better margins, positive cash flow, and a product portfolio that didn't exist a year ago. Whether the revenue recovery in 2026 lives up to the setup is the real question to watch. Keep an eye on this one as they continue in 2026 and into 2027, and I will keep you updated.